So to open the show this morning, I'm really delighted to be able to welcome Julie Langley from Results International, who's going to give us a little bit of a perspective from the sort of M&A investment side of the world on the ad tech and martech industry, also from an international perspective, to let us all know what we can be looking forward to over the coming 12 to 18 months. So round of applause to welcome Julie onto the stage, please. Thank you.
Great, well, thank you very much, Rachel, and good morning, everyone. ExchangeWire have assembled a fantastic lineup of speakers for us today. You're going to be hearing from people with great experience operating at the cutting edge of digital marketing. So just to manage expectations, that's not me. I'm an investment banker and have been for about 20 years, so probably as far as you can get from the cutting edge. But we do spend a lot of time in the sector. We advise ad tech and martech companies on M&A and fundraising. So as Rachel said, that's the perspective I'm going to take for the next 20 minutes or so. It's been a lot of doom and gloom in our industry. I'd like to reset the tone a little bit today. What I see is an advertising industry that's worth $600 billion globally. Digital advertising growing at double digits. Programmatic, 30 to 40%. And the biggest budget of them all, TV, hasn't even come into the equation yet. That looks to me like a pretty healthy industry. Let's take a quick look at a share price index. As I said, I'm an investment banker. This is my comfort zone. This is a 4-year share price index. What do you think that might be showing? Ad tech. But it's not. This is the NASDAQ from 1999 to 2003 during the dot-com boom and then bust. This line, this is ad tech over the last 4 years. What we are seeing in ad tech is not new. It is what every single disruptive technology industry goes through at some time. And just as back in 2001, 2002, we were really only at the very beginning of the dot-com revolution. Most of the growth opportunity and the disruption was still ahead of us. And that's where I think we are in ad tech today, with the opportunity still ahead of us. There is, however, one difference between what's happening in ad tech and what happened at the dot-com boom and bust. And that's what's happening in M&A. What would you expect to be happening in M&A given this bloodbath in the public markets? You'd expect it to be a desert, right? But actually that's not the case. Let's take a quick look at the stats. In 2013, there was 61 M&A transactions in ad tech, and I'm talking about just about ad tech now, globally. That soared to 135 in 2014. It grew again in 2015 to 155. In the first half of 2016, there have been 60 transactions globally in ad tech. So if that continues at the same pace, there'll be 120 transactions globally in ad tech this year. So yes, that's a fall, but it is still a very healthy M&A market. There is clearly a lot of strategic interest in the ad tech sector. And so given this strategic interest, what is it that's been causing the problems that we've had and all experienced and all felt over the last 2 or 3 years? Well, I think it's actually very similar to what we saw in 2000, 2001. Too much money has been raised at too high valuations. Nearly every ad tech company that has gone public is currently trading under its IPO price. If you look at the venture capital market, too many companies raise Series A, Series B rounds at 60, 80, $100 million valuations. And they haven't been able to get the exits that make their investors happy. The sums just simply haven't worked. So what we've got is a fundamentally attractive high-growth market where too many investors have had their fingers burnt. But that is a temporary, albeit painful, problem, and it will work its way through the system. I think there are plenty of reasons to be optimistic about ad tech, which brings me on to my reasons to be cheerful, part one. There are lots of buyers in this sector. Let's take a look. There were 215 M&A deals in the last 18 months in ad tech globally. But more important than that 215 is the next number. Those deals were done by 186 different buyers. That is a huge number of people, players, who want to be in ad tech. Let's take a look at who's doing the buying. We think of the buyer community as being broadly in three categories. The first category is what we call the usual suspects. And this is the pure play ad tech players and the marketing services groups. What I think is quite interesting about this chart is that 42% of deals in the last 18 months have been done by the pure play ad tech players, the AppNexuses and MediaMaths of the world. And I was actually quite surprised when I saw how big that number was. But this is 42% of deals by number of deals, not by value. Typically, these players have been doing very small transactions. They either don't feel they can or they want to write large checks. The next group that we put here is marketing services. And this is the WPPs and Dentsus and IPGs of the world. And actually, those players had been relatively quiet for a couple of years. Generally felt, I think, that they had their tech stacks completed. But they've emerged again as acquirers over the last 6 to 12 months. We saw WPP buy ExchangeLab, and most recently Dentsu buying Accordant. So that's the first category of buyer. But I think it's the second category of buyer, which actually where things start to get exciting. The next category is the new entrants. And this is really anyone who's anyone within the TMT landscape is circling around ad tech. First of all, the traditional media players have been very aggressively acquiring, and particularly the broadcasters, the Comcasts and RTLs of the world. And I think what is encouraging is that they are trying to learn from what happened to the print publishers. And they're trying to get on the front foot and take control of the value of their audience and take control of monetization. And I think they're in an interesting place because they own must-view original content, which is becoming increasingly important in the equation. So we certainly expect those players to continue to be acquisitive in the sector. The next one is the telcos. And the telcos, we all saw Verizon, AOL, Yahoo, but Telenor, Singtel, a lot of the telcos have been doing deals in the space. And actually, they're the ones who've been writing the really big checks. And they can. One of the interesting features about this group of buyers is they have huge number of subscribers. They have lots of interesting data about those subscribers, particularly mobile-based, location-based data. And as long as they can figure out the data privacy conundrums, that's a useful asset. But also their core market is flat. And they've got deep pockets. So actually, they're looking at ad tech as a really interesting growth segment to get into. Other buyers in the space, the data players, particularly the offline data providers who are moving online, internet and e-commerce, people like eBay, Twitter. We'd also put Google and Facebook in here, although actually if you look at the deals that they've been doing in ad tech, it's, again, pretty small deals, haven't been writing large checks. And then marketing technology, people like Oracle, Adobe. And I'm going to spend a bit of time on them, so I won't cover them now. The third category is what we're calling the emerging players. Now, these are also new entrants, but there is a distinction between the category I talked about before. because these are players we have never heard of before. Miteno, anyone? Yeah. This is the players who are entering the space completely from left field and very often from Asia. So I think we all saw Miteno buy MediaNet for about $900 million a few weeks ago, but they're not the only ones. We actually have a team on the ground in Asia, and everything we hear is that this is just the tip of the iceberg of interesting Asian players from outside the sector who are looking to get into the sector. So what we have is a market where 47% of deals are being done by new entrants into the sector. And it's that high level of strategic interest in the sector which is driving my reasons to be cheerful, part 2. Strategic multiples are achievable. Valuations are down across the sector. I'd look pretty foolish if I stood here and told you otherwise. But these are just some of the deals that have happened in the last 12 months where strategic buyers, mostly new entrants to the sector, have paid what I would consider healthy or very healthy multiples to move into ad tech. So we've got an interesting thing going on here, which is that there are healthy multiples being paid in M&A, and yet the public markets are absolutely falling through the floor. So what is it that's causing that difference? Well, it's 2 things: scarcity and synergy. If I'm a public company investor, I can hold a stock of any company I want. It is a purely financial transaction. But if I'm Oracle and I want to have cross-device capability, there are probably only 4 or 5 companies I can buy globally. And there's going to be 7 or 8 other parties chasing those assets. So there is scarcity value. But there is also synergy value. Again, if I'm a Comcast or a Rakuten or one of these buyers, there is synergy. I can buy a $20 million net revenue business and turn that into a $60, $80, $100 million net revenue business in short order. And how do I know I can do that? Well, I know I can do that because in many cases, I'm already partnering with the business that I'm buying. If you look at these deals on this slide, I'd say well over half there was an existing commercial partnership between the buyer and the seller. And I think for those of you out there who ultimately are option holders or company owners and thinking about where does my exit come from, that's a really interesting thing to think about, which is who am I partnering with? Who knows the value of my proposition? And then rounding out our reasons to be cheerful, part 3. Funding is out there. It is a myth that the VCs have shut up shop for ad tech. It is not a myth that they have shut up shop if you have a Me Too undifferentiated proposition. And that includes the slightly better mousetrap for display buying. But funding is out there for differentiated propositions with barriers to entry and with strong management teams. Over the last 18 months, European ad tech companies have raised $262 million. And that's come from a very wide variety of sources: US and European VCs, corporate venturing arms, increasingly from debt providers, actually. And it's gone into a really wide variety of companies. Companies in mobile, in video, in location-based targeting, in visual search, in publisher-side solutions. But the common theme is they all have a differentiated proposition and a management team that investors are comfortable to back to continue to adapt and reinvent themselves in this ever-changing industry. So there are reasons to be positive about the industry today, many reasons. And looking to the future, what does the future hold? Well, we can't have an ad tech conference and not talk about the conversion with MarTech. I know that we've got a panel on that shortly. In my opinion, it is inevitable that advertising will converge with marketing. the lines between traditional advertising and the rest of the marketing mix are blurring. What is the difference between a highly targeted ad on LinkedIn or Twitter and an email or other sort of first-party customer touchpoints that traditionally have belonged in marketing? Increasingly, there is no difference, and it makes absolutely no sense for these two functions to be managed in isolation. So there is going to be convergence. But right now, these two industries are very distinct, and nowhere more so, actually, than in the way they're valued. The average public ad tech company at the moment trades at 1x net revenue. Where do you think the average public MarTech company trades? 5, 6, 7? 7.8 times net revenue. So that is a pretty scary slide. So before you all decide to pack up and head out to the pub, let me just put it into context and give you two really critical observations about those stats. The first is, it is a spectrum. And a business like Criteo, a scaled programmatic business, currently trades at about 3 times. So it is a spectrum. The second really important point, and probably the most important point, is that this is where public companies trade. And as we talked about earlier, there is a real disconnect at the moment between public companies and strategic M&A. And multiples for strategic M&A transactions are better than this. Very substantially better in some cases. But there is still a distinction between AdTech and MarTech. Well, that's easy. I just rebadge myself, right? I change my website. And we've certainly seen a bit of that going on. Unfortunately, it's not that simple to move yourself from one side to the other. It is the business model of the marketing technology companies which is underpinning this difference in valuation. High gross margin. MarTech is a traditional enterprise software proposition with 80% plus gross margins. So for every $1 of revenue I spend, 80 cents falls to the bottom line. So that's scalable. Sticky license revenue. Most ad tech companies have a transactional revenue model. They sell on a percentage of revenue, percentage of spend, and therefore don't have great visibility or predictability about their revenue streams. Most MarTech companies are software as a service businesses. They sell on a license fee basis. But it's the sticky that's really important here because it gives them long-term revenue visibility. If your client can turn your revenue on and off without causing themselves pain, you are not sticky. If you're a Demandware or Salesforce, it is painful to implement you because you are deeply integrated with the client's systems, but it's also painful to rip you out. And the final point is direct to advertiser. And this is something that we're actually hearing more and more about from buyers. They are increasingly looking at ad tech and asking for direct to advertiser propositions. And that, of course, is challenging because that's not how the industry runs today and it's not how the industry has grown up. But it is an increasingly hot topic and discussion point in the conversations we're having. So the industries are going to converge. And the people doing the converging or driving the convergence at the moment are the enterprise software vendors who moved into MarTech 7 or 8 years ago, the Oracles, the SAPs, the Salesforces of the world. And for the most part, they started in CRM. Not Adobe, obviously, they came from a different heritage. But they started in CRM, they moved into content management, they moved into e-commerce, into email, into marketing automation, analytics. And some of them have moved into DMPs and cross-device capabilities. And in fact, it's Oracle. Of all these parties, our view is it's Oracle who's actually the most advanced in terms of moving from MarTech to AdTech. I know that we've got Oracle on a panel shortly, so I'd be really interested to hear their views on where this stops or doesn't stop. So far, none of the MarTech players have really taken the leap into ad tech or media buying. Probably it is a big leap. It is a very different business model, a very different industry. Our view is it will come. And is it inevitable that it is MarTech that will eat ad tech, which is the headline we keep reading about? And if you look at these MarTech players and look how large they are relative to ad tech, the inevitable conclusion in some ways is that yes, they will be the consolidators. But I think we do a disservice to ad tech to underestimate the power of ad tech within this convergence. Advertising is, as I said, a $600 billion industry. And by most estimates, advertising represents over half of a large advertiser's marketing budget. And who understands advertising? Who controls advertising today? Well, it's the media owners, it's the media agencies, and it's the ad tech companies. So I think we collectively owe it to ourselves to think about how do we help value that in the convergence that inevitably will take place. And so to round up, or to summarize, I thought I'd take a little look into the future and try and imagine some of the scenarios that we might see in 5 or 10 years' time. I should caveat that this is merely my personal speculation. If there's companies here in the room from some of these parties that I'm going to be talking about, they will probably say this is not on the cards. I'm sure they'll say this is not on the cards, but ours is an industry that changes so quickly, none of us really know what's coming. So I thought we'd have a little bit of fun and talk about some different futures. First of all, Accenture overtakes WPP as the largest media buying globally. We haven't talked about the consultancies, and they have, as most of you will know, been very aggressively acquiring digital agencies over the last 4 or 5 years. They haven't yet moved into ad tech or media buying. But Accenture is a $3 billion digital agency, and it's the fastest growing digital agency globally. And increasingly, they are sitting at the top table and involved in the high-value strategic planning discussions that are happening around media. Where will that end? $600 billion is a very big prize. P&G returns to original content production. Now, I don't think anyone in the room here is old enough to remember, and that includes me, that P&G invented the soap opera. In order to build audience for a new medium called radio, P&G produced original content. Original content drives audience, probably now more so than ever. And as the brands see their industry disrupted by the disconnection with consumers, disrupted by Amazon moving into white label products, for example, they're going to have to think about how they respond. And again, I think they've said they're not going into original content production, but who knows what will be on the table to cope with the disruption that is inevitably coming. And finally, Netflix rivals Google and Facebook's walled gardens. We all know the stat that 75% of every incremental dollar that is going into digital advertising is going to Google or Facebook. Who can challenge that? Well, I think I would place my bets on the owners of original must-view digital content, video content. Netflix, of course, has an ad-free model today. There's a lot of debate about whether that can last. How can they sufficiently monetize their audience with an ad-free model? I think that's a really interesting one to watch. It is a business that has constantly reinvented themselves. It's a business that started posting DVDs to me and is now one of the largest producers of original, interesting digital content globally. Amazon, of course, you'd put in this category as well. You may agree with me about these, you may disagree, but I think one of the things we will all agree on is that actually none of us know what this industry is going to look like in 10 years' time. If we'd been sitting here at a transportation conference 7 or 8 years ago, none of us would have seen Uber coming down the track. If we'd been sitting here at a hospitality conference, we wouldn't have seen Airbnb coming down the track, even 5 or 6 years ago. None of us know what the future holds. But I think to sum up my views on the industry and kind of looping back to where we started, I think the hype is over, but the disruption is just beginning. Thank you very much.
I feel amazing after that. Does everybody feel amazing? We are working in the right industry. Yes, round of applause to Julie, please. I knew it. I knew it. So did you. Julie, brilliant presentation. And thanks for doing our opening speech at the ATS this year. I just want to talk a bit briefly about the buyers, right? Strategic buyers, because obviously with, traditionally you have Google buying, Yahoo buying, and now the Verizon's gobbled up Yahoo and AOL and Google, who have the complete stack. They don't need anybody, apparently. The strategic buyers are now the most interesting people in the space, particularly the telcos. Now, I wrote an article about why the Verizon deal was a very, very good deal, them buying AOL and Yahoo. So why are telcos buying ad tech? Because it's not core to the business, and there has been some examples of telco companies who have done advertising and, let's be honest, really messed it up. What's different now?
Yeah, look, I think if you look back actually to the dot-com era, the telcos missed the boat in terms of seeing the change that was coming. And I think they're all trying to learn from their mistakes. And if you look at their core business has flat revenue growth. In some cases, it has negative revenue growth. But what they do have is huge amounts of data, location-based data about huge number of subscribers. And how do you take the cash flow that's being thrown out of a flat core business and put it into something with growth? I think they're all seeing ad tech as a very logical step. And they might not succeed, but I think you've got to applaud them for having a go, really, and not waiting to die.
And do you think they're going to buy more? Because you've had Tanner buy Tapad. Singtel seem to be on the hunt for everything. If you believe rumors in the press, they may have their eyes on another platform. But do you think they're going to buy more as we go along? Have they only started?
I think they've barely started. In fact, what's interesting about the stats that we track is it's only 3% of deals are done by telcos today, but if you looked at deal value, it would be much larger than that. They've barely started. I think we've seen the tip of the iceberg. And in our conversations, that's what we see.
Yeah. And the other interesting one is, I don't know if you've followed Terry Kwaja. I'm sure you do. Terry's a bit of an icon in the industry. He's a self-publicist and very good at it. But he's pictures of him getting on the plane to China, which is hilarious, And yesterday, Kwaja goes to China was trending on Twitter, like Nixon go to China. Only Terry Kwaja can go to China. But the interesting part is why are Chinese companies buying ad tech? Because I've heard similar stuff in London as well. They are looking at companies. What's the rationale?
But look, we have people on the ground in China, so we don't need to tweet pictures of us flying to China.
Boom, lovely, Julie. Straight in there. That's why I like this woman. Don't mess around.
And that's just the tip of the iceberg is large Chinese communications equipment manufacturers. We saw it was a security software company out of China and a gaming software company out of China that were in the consortium to buy Opera MediaWorks that ultimately fell through, the MediaWorks piece. We're going to see much more of that. Companies we've never heard of emerging as buyers in this space. And what they see is a growth industry. And they've got cash to spend. And
they look at to sort of to grow internationally, or is it bring that stuff into China and to build
to grow internationally? They're all looking to grow internationally. These are not, and it's not financial transactions. I know some people have looked at it as a financial transaction. This is about entering international growth markets.
Yeah. Interesting point there where you said public markets are divorced from M&A. Let's go a bit more deep into that, because obviously we've seen a lot of ad tech companies get absolutely slated. They've had okay IPOs. I mean, look at Rockefeller. They're the sort of the the basket case of this particular example. Like, they go public and what's the big hush for you? 81% drop in stock prices, hardly, So why would you say that the market's a divorce from M&A then?
I think there are some very specific examples of companies that have gone public too early with opaque business models at best. They've probably used quite a lot of smoke and mirrors in their IPO and in the way they presented their business. There have been specific issues around fraud. So I think there is some specific issues with the companies that have gone public. But I think the much bigger reason is what we saw with the number of strategic parties who want to be in the space. And if buyers want to be in the space, they have to pay strategic multiples. If I'm a founder of an ad tech business, provided I have cash and I'm not running out of cash, I can choose when I sell the business. I can wait till I get the right offer that reflects the strategic value.
And it's interesting that Criteo have managed to keep their valuation quite high. Is there a specific reason? Because they're typically ad tech. They don't. They own their own technology, but they don't own any media or unique data. So why have they managed to keep their valuation so high?
Well, I think there is one interesting factor about Criteo, which is that they sell primarily direct to advertiser, and I think that gives them an advantage. They're scaled, actually, and they have executed incredibly well. I think it's about almost flawless execution. They haven't got caught up in the problems that other ad tech companies have got caught up in.
Yeah. And then there was the interesting point there as well about the amount of money raised. I often feel that I have typical conversations with friends in the industry saying the optimum sort of price might be between $50 and $300 million in terms of an exit, and then after that you've got a couple of companies that will always probably sell for. Do you think that if companies, as you say, are differentiated and don't raise too much money, that the possibility for them to have a big exit is there? I mean, a good example is obviously Sticky Ads, who raised maybe $5-6 million. I'm not sure that's public, but sold for in excess of $100 million. It is public now. God damn it! Where's the Twitter wall? There it is. So I mean, is there sort of a rationale behind actually keeping your sort of cash burn low and building that business and not raising too much money, because I've seen that's a problem.
Yeah, I think the market has shifted from valuing revenue growth and now profitability, or at least a clearly viable operating model, is in the ascendancy. And I think it's a great discipline, raising relatively little cash and executing on a flawless strategy. Is you look at a business like Sticky Ads, it had some scarcity value because of where it sat, video SSP,
video,
programmatic.
Yeah.
So it absolutely had scarcity value. They would have had some synergy value. But I think more than anything, that was just a business which had grown incredibly well. It hadn't had the problem of too much capital.
And you talked about TV. I mean, everybody in this room is just looking at the TV market greedily. $300 billion, not yet addressable. And I was at a conference there this week, TV Rise, which is a programmatic TV conference, and there was a sense that the innovation in programmatic TV is not actually coming from the agencies and the marketers, that it's actually coming from the media companies themselves in a defensive thing. Do you think that the likes of Comcast and all those big media companies are actually making a defensive play against the likes of Google and Facebook, who are really eyeing up their business quite aggressively?
Yeah, absolutely. I see it. They're going to be really aggressive. I think they've got the benefit of hindsight, right? They can see what's happened to print media companies, and they're all getting on the front foot. And they're also in an interesting place, which is that they've got the video content.
Yeah. So the content piece is huge for them.
The content piece is huge. I think in a industry where, of course, there's ad blocking and we're all more and more blind towards advertising, we're disconnected. Actually, the pendulum is shifting to parties with more must-view video content.
Yeah. And I want to talk about some of your predictions as well, because there's obviously a few agencies in the room who are worried about their jobs. Accenture, obviously, they've been labelled as one of the biggest digital agencies in the US. I don't know where they get their figures from, because I'm not trying to figure out, they don't buy any media. So how do you go from 0 to beating WPP in the media race? Is this all geared around data and automation, or is it something completely different that I haven't missed?
If you look where they've gone to in digital agencies, sort of website design and build and digital services generally, they've done a lot of that through inorganic growth, so acquisition. They could well do the same thing in media, but actually they may not have to, because as the media evolves, I think if you look at the media buying industry, it's absolutely ripe for disruption. I don't think any of us know how media is going to be bought in 5 or 10 years' time. And they're in a strong place. They understand data, they understand analytics, they understand automation, they're in these clients already. So I think there's different ways that they could get into the market.
And the MarTech, AdTech piece, there seems to be this dance going on at the minute, right? Oracle and Adobe, they're all kind of shuffling around the dance floor. They're not actually doing anything, not getting involved, When do they make a big sort of AdTech acquisition? When does that happen? Because they've put their toe in the water with the MPs and data, but do they really want to get into this business? Because the media business can be not very sassy, if there's such a word. It is going to happen. That's my view. It'll happen next year, I think. I'll put it out there. Are you working on some deals you can tell us about? Just tell me.
Nothing that's in the public domain.
Okay, right. Like the sticky ads, raise, obviously. Julie, thanks very much. Round of applause for Julie. That was fantastic.
Thank you.
I have to stay on the stage.